Everyone. So we have good. Thank you for joining, everyone. And I think a lot of people are joining. Around 17 people came in. So we have just a minute. I am trying Thank you for joining, everyone. I'm trying to put this on search funder. So just a minute. Hold on. I'm trying to put this on. Okay, guys, I think we are live on Search Funder also. I was trying new things, and I welcome everyone. And I have Nayab, Ryan, Sam, Dalton, Austin, Jason, Everest. Thank you very much for joining. I'm Sandeep Dal. I have been doing a lot of networking. California and Bay Area lunch meetings over the Zoom here on Search Funder almost on a weekly basis. And this time, Nayab, who is a friend and a partner of mine, we were always, when we were going into the long searches on, months of searches as a searcher, we were always going through a lot of businesses which have good potential, but do not seem to be cash flowing at this point of time. So we were evaluating, and then it came onto our mind that why don't we ask everyone and ask a lot of people and see what they are doing. Nothing is right or wrong. Everybody has their own style of working. And I have been looking at cash flowing businesses myself, but this has come to a point where I thought it is important for everyone to have maybe a discussion and say whether the other opportunities like something which is not cash flowing, something even break even or maybe a little distressed right now, is it a right opportunity for searchers to get into or not? So this is the background of our call today. Now, welcome Vladimir and Rol also, and would you agree with this thought today, and then we can start our conversation? And is it okay if I call for each one's opinion, or if you have any question or any comment, you can also jump in anytime. This is a roundtable discussion where I'm not providing any special content except for my own thoughts and opinions about the subject. I will start this topic by asking, is this okay to say in our discussion today that distressed business is not the one which is getting into bankruptcy, where my definition of today's discussion is something which is distressed, which is have not been able to give enough cash flow to the business owner and has been struggling and just around break even, or have not been able to reach out their potential. So that's the background of my thought, and I would like anybody to jump in and share what do they think about this definition of a distressed business, and is it okay to go forward with this further on this discussion. I will go from my right to left. Ryan, you are on my right now, so is it okay to give your opinion on this? Hi.
So as I've been upskilling in the search fund worlds, I've seen most of the guidance focused on established businesses and generally guiding against distressed. Now, with my experience in the workforce, I think there's potential there to dive deeper, but I haven't been able to find much material supporting what that looks like. How do you define a distressed business? Everything you just touched upon. So I can't say I've given much thought, but as to the definitions, but what you've described seems reasonable to me. And if we get other people with additional definitions, I think that would be beneficial, because I just don't see a lot of thought leadership and guidance as to what this is defined as well as how to pursue it. Unique qualities in negotiating that type of deal.
Yeah. Okay, great. Anybody else, any points on that? Or should I say Victor, Nayab?
Yeah, so I think when Ryan was talking about like you talked about the definition, and Ryan was also alluding to the same, because when we call out distressed business, normally, I mean, people always tend to go to businesses which are almost at the verge of collapsing. It's something where, I mean, the banks are taking over the assets of the business, and they're almost at the verge of liquidation. So, but I mean, for our discussion today, since we are talking about those businesses which are, you know, earning some revenues, but their bottom line is not as healthy as a normal business. And for searchers, because a lot of times we are looking at businesses which augment our cash positions, and from day one we want to, you know, see something, you know, flowing in. But there's so many businesses who, and trust me, I mean, with all my experience in acquisitions and mergers and acquisitions, there are businesses where we sit on the blind spot. There are few things that we can do very well to these businesses to turn them around very quickly into cash flowing businesses. So I think, I mean, it's a very important topic for us to, you know, understand that, look at these businesses as well. And to Ryan's point, if we don't have like a lot of guidance around that, let's have the discussion amongst this group, so that we look at the challenges that are being faced by this group and see, I mean, what are the solutions like, and we can have that healthy discussion.
Yeah. Okay, great. Anybody else, any thoughts, or we go on to the discussion, and I can keep you know, asking for your opinion? Nothing. Okay, so I agree with this thing, that I think the definition, will go with this definition, the loose definition, and not go in for the distressed means the bankruptcy and all that, because that's not where we want to be in. I think when we look into distressed businesses, like Nayab and I have looked at many businesses, and we look at things like, there are a few businesses where many business owners come and tell us, you know, their business could be worth X, but the last 10 years they have been barely able to even take their salary out. Something has happened in their business. Now, if I look at that business, there are a few people on the call. I need to let them in. So when I look at these businesses, I look at whether the business model is correct or not, whether there is a potential or not, whether there is a gap in pricing or not, whether they have overheads which could be worked on. So all those things are important, in my opinion, to evaluate a business where even though the business is not meeting their targeted profits or cash flow, but there is a potential. Is there anything else would you like to talk here, and jump in, whosoever wants to jump in here?
Yes, indeed. This is Austin.
Yeah, hi, Austin.
Hey, I posted something about this on the Search Funder forum a couple weeks ago, a friend's request, because I'm looking at, I phrase it as a turnaround, but it's, to your point, it's distressed, but not calling upon creditors. It's just barely break even. When you kind of look at it and you add back in salaries and stuff like that, it kind of becomes a cash flow negative. They're at a loss currently. And so I think when I learned from that post was just, as a searcher, I'll speak for myself as a searcher, there's a lot more it's a lot more complicated than I have experience doing. I think I'm a pretty good operator, but I haven't worked specifically that turnaround kind of mentality, right? Where your only main objective initially is just cash flow positive, right? And you do whatever it takes to get there. So I learned that. And two was just the other advice that came in was it's going to cost more to turn it around than I probably would expect it to, as far as investments in systems and equipment, not in the sense of cash to stay afloat, but cash in investments to right the operational deficiencies or so you can come in and try to cut costs. And so that was one element. The other was probably needs some capital investment, because part of why I think it's maybe good for searchers to look at is because it really can be quite discounted and essentially cost me nothing to get a business that has strong sales, but no real earnings. It's not profitable. So it's kind of like, the typical search fund model where you're trying to find that good business and get it better. But you have this initial trough to kind of get through to get back into good business land. You're starting off with that cash flow negative. And so I guess that's what I learned was, so I think it could be a great opportunity if you have maybe the right advisors or the right team to help you navigate that trough, how to get to cash flow. I'm still in the midst of evaluating and working with the current owner. So I don't have a did I do it or not answer. I'm still in evaluation, but I think it's a great topic. I think it's not really processed much on Search Funder. So it's great. Thank you.
Okay, and that's wonderful. And Vladimir, I think you raised a hand, and would you like to speak?
Yeah, I had a more of a follow-up question, follow-up on the original question you had and the definition of what makes a business distressed. And you mentioned business has been struggling for 10 years. Now, I'm just curious, what's the cutoff point that when you look at a business, you say, hey, this business is something worth for me to even look at? Because 10 years is sort of a very long time, especially in so much change in the last 10 years.
Yeah.
The cycle is so much quicker now that, I feel like, and we're talking about non-venture backed, businesses that do not have.
Sorry, are you guys frozen also, or is it me?
I think it's just you, Cindy.
Okay.
So we're talking about businesses that do not have endless capital to burn. Small businesses, small, medium-sized, they do not have 10 years of runway to figure stuff out. Their runway of time is much shorter. So when you look at a distressed business, what do you look at? What markers do you consider to say, hey, I don't want to spend more time on this than I have to?
I think it's a great point, and and I would like to talk about 2 points which kind of leads to it, and with my experience. First, I think I will ask Nayab to explain what he explained me when we were talking about this turnaround, was that there are 2 kind of turnarounds. One is a profit and loss account turnaround, profit and loss not account, P&L turnaround, and the other one is a balance sheet turnaround. So he will explain to me about that because he has explained that beautifully. But before we get into it, it does not, in my opinion, Vladimir, there are reasons why the person has not met maybe for the last 10 years. One reason, when I owned a marketing agency a couple of years back for a small period of time, and I used to reach out to a lot of old school manufacturing kind of companies or service companies and all that. The most of the business owners who were kind of struggling and who were just taking their just limited amount of salary from California perspective used to tell me, oh, you know what? My customers find me all the time. I don't need an online presence. I don't need this. I don't need that. So they're so proud of themselves of being found that it is very difficult for them to believe that there is a need for something else, because it is very difficult for them to accept that if they do not go in for an online presence, this 10 year they have been struggling or not, next year, maybe 3 years from now, they will not even exist. That's the mindset I'm talking about here. So I agree. It's very difficult for me also to go and think, hey, I can go and invest money, because you need some amount of extra cash, which we as a searchers we don't have, unless we are funded with somebody who was deep top pockets. Now, another thing which I would like to, before I asked Nayab to go into this, that when you talk about cost more and cash inflow and efficiencies and all that, yes, I agree with you that businesses which are a little distressed can be had it for a song, or less money, and even sometimes zero money down, and then we can help them turn them around. But I want to be very cautious about it, and I don't want to take somebody's liabilities thinking I will be able to manage them better. This game is played on this mindset that I am a fantastic guy and I'll take over these liabilities and I'll manage it better. Now, that's a lot of hard work, a lot of due diligence to be done. But I would, before we go deeper into it, I would request Nayab to explain me the fundamentals of two kind of, or maybe a little bit overview, or two kind of turnarounds, and then we go deep into it.
Yeah. Absolutely, Sandeep. Just before I delve into that, a small, personal experience, and to the question that Vladimir asked, like I can quote you one of the examples. Like, small to medium-sized business had been, in operation for the last several years. What happens is, we are always doing business to, increase our bottom line, to, increase our equity over a period of time. Normally with small to medium-sized business, especially family-owned, what I've seen is they involve their sons into that, they involve their wives into that. So there's an opportunity cost for all those resources who are contributing. So we are not counting their salaries, but at the same time, they are in the business. The whole family is, working towards achieving that goal of, equity enhancement or profitability increase, but they're hardly meeting their ends. It's enough cash to just sustain their family, right? It's just enough cash to sustain the business. So the business is not getting liquidated. The business is still there, but they're not able to, find the right sort of balance where they can increase the the equity and achieve the ultimate goal. So that's some of the businesses that I've seen where they keep failing and they have those blind spots. They don't know what to do. They're only looking at cash flows. As far as they've got some cash in the bank to keep the operations running, they are surviving and they're keeping the business afloat. Sometimes when there is a problem, they go for credit card, they go for short-term loans, they go for a friend from family, keep the business afloat, but it never achieves the potential that the business could have. So these are the businesses I think we can always focus on. So that's the first thing, some experience. As far as the restructuring models are concerned, again, I'll not go into a lot of technical or accounting or financial jargons, but simplistically put, what happens is most of the time, people look at only profit loss. For example, what is my top line revenue? My top line revenue is $10 million. How much I am making? The moment they ask this question, they always go into cash, not the profit. Why? Because normally people think in cash flow terms, not in accrual terms. So when we are looking at profit loss, restructuring through profit loss, which means, first of all, the question is, are we looking at it on accrual basis or cash flow basis? Then are we delving deeper into, is my revenue, that $10 million of revenue, fetching enough margins? Again, a lot of time people are just sold to the idea of getting a high value on the top line without giving consideration to my gross profit margin. If my gross profit margin is being eaten up by that high volume, low margin type of activity, which means ultimately it will not be able to sustain my other operations, which is my administrative costs, my salaries, other expenses, right? So when we are looking at it on the profit loss side, again, very, very simplistically, we have to look at it accrual basis, not cash basis. How we are fetching the margin. Is our margin increasing with our activity, or by increasing the activity, we are just reducing our margin over a period of time? So a big, red flag if that is happening. So that's how we look at our profit loss. But at the same time, what happens if you've got any maybe people in the room who have got a little bit of accounting background or understanding, when we say financial statements, we are not just talking about profit loss. We are talking about profit loss, balance sheet, and cash flow as a whole. And when we talk about balance sheet restructuring, actually we are looking at the working capital management. A lot of time when I say we are only looking at cash flows, they look at the bank, they say, hey, I've got like $5 billion lying in the bank. This is enough to sustain me for the next 6 months. I'm happy. But at the same time, there is a working capital mismatch which is happening somewhere in the balance sheet. Your liabilities, your accruals, your debtors, and receivables, they are not matching up, and over a period of time it's deteriorating. But you are happy because I've got my cash in the bank. So whenever we are looking at restructuring, we can't look at our profit loss in isolation, but in constant in coherence with my balance sheet. And then ultimately, where are all these cash funded from? Sometimes what happens, people keep funding the operations from loans. And where are those loans sitting? They're not sitting in the P&L, they're sitting in the balance sheet. And where that impact is being captured, it's through the cash flow statement. So whenever we are restructuring a business, we have to think about the business holistically and not in isolation in terms of only revenue or my margin, net profit, or cash. Yeah, so very, very simplistically, that's a high level discussion we were having with Sandeep.
Thank you. Rahul has a question, and Rahul, please. Or not a question, I should say. Rahul wants to speak. Sorry, there's no question here.
Thank you, Pradeep. Just wanted to share a case that I'm working on. I've been following the model, the search fund model, and I found this business. This is my target number 2 this year, but this business had losses. Well, they lost money last year, and the previous year broke even, barely. But this business has been working for 17 years. The owner, 74 years old, he just wants to retire, no succession plan. And I told him, okay, so how much? What's your plan? He said, I just want out. I need somebody to take control of my business. And I asked him, okay, I cannot make you a good proposition because you have losses and my model doesn't work with that. And he told me, okay, give me an offer. And I'm working with him an offer with a 60% seller's note through 4 years. And he said, yes, we can work with that. So, that's a way that I'm looking at as reducing my risk, right? And getting into that opportunity, because I think it is a business that deals with our manufacturers' water treatment systems. So it seems to be a good business. The last 2 years he had issues with COVID and stuff like that. So and they had projects. All the projects have a positive cash flow, but the expenses to maintain 40 people in the business, that made him put money, right? But so this is what I'm doing right now.
Awesome. Any other comments from anyone else?
Just one thought. Just one thought, on what Raul said. So basically, it comes back to the same point we were trying to make, that the business is already there, 17 years. The business could manage to survive, but couldn't achieve their potential. And one key point that Raul just mentioned was feeding the 40 individuals out of the revenues or the profitability, which means if you do a sort of a diagnostic, the very first question would be, what are these 40 people doing that they are not able to contribute to the bottom line? So I think, that's the very first question somebody would ask.
And fantastic. And that is where the opportunity lies. So I'm not saying we should buy somebody, like there are people who may be buying bankruptcy companies and all that, just like an internet sensation guy, I don't remember his name, he's buying Peerless Imports and all those kind of brand names which are collapsing. I'm not talking about that. We are searchers. We want cash flowing companies, but sometimes the cash flow is not, or the profits are not that visible but a trained eye can see a quick fix to that or restructuring, and then say, I think I can make it work. Victor, you wanted to say something? I saw you unmuting.
Yeah, sure. Just really wanted to share some insights from my part. When I finished undergraduate, I bought actually a distressed company that was heavily distressed, not very conceptual and not after any nice guidelines actually, and had some like empirical experiences there. And just what I would also say from a market view of point, I think there are, like Vladimir also said before, these businesses don't have a lot of runway usually, as they're quite small. And I think there are two distinguished situations that at least helped me, because I think there's one like business that has growing struggles, which actually are reflect in distressed situations, and usually, or at least in my part, it was like really basic management things that could have been done, let's say low-hanging fruits, and regarding controlling key business model things. And then on the other hand, you have distressed businesses that are just on a like market share declining struggle, and where it comes from a very different direction. So I think so very subjective points, and I'm just very interested in all of your opinions here, trying to learn. But yeah, I think just in my case, it was really a good product that convinced me so much, and I thought everything after that product was bound to you should really change all that. But yeah, I think this to distinguish a good product and like growing struggles and low-hanging fruits are really maybe the key to find there.
Okay, awesome. And I agree with you that there is a product, and if it is the cash flow, like somebody said, I think Austin said, that there is a more cash inflow is required. And if it is beyond our comfort, I would say look at the business much more carefully. And if it is sucking the cash so much that we cannot afford it going forward, it's difficult. And I agree with you, we should not go in for that kind of a business. But if something can be quickly changed in that business, and I'll give you an example, quickly does not always mean reducing the overheads. It can also be that I have been involved with a pricing consulting company in the past. It can be just looking at a pricing of the company, and if you can maybe increase it by 25% or maybe double it, sometimes it is required because the guy has not increased it for last 25 years or 20 years or 10 years, and that may be the thing which we can quickly do that and get something out of it. And there is another example which I just made a note of when you guys were talking. There are hundreds of companies who are trying to increase or their revenue or top line at any cost. And I see an example I heard in one of these chats about an e-commerce guy who told about his own not a success story, his own story or a case study. And he said he was earning accolades, he was earning some what do you call that, some awards for increasing the sales to 5 million to 6 million to 8 million and 10 million, and still at 10 million he was bleeding, and he was losing profits. It was a net loss. Whereas if you look at that kind of a company, in my opinion, and that's how I look at it, and say, maybe that company is not even required to be at 10 million. Maybe we can just look at a quick size it and just stay it at 4 or 5 million. And then as a searcher, add more other companies around it, and then maybe acquire other companies and make this as a platform company. So what do you think about that? So rather than keep on increasing and sell more products to be able to one day get profitable, or reduce it to a profitable level, even if it makes sells less, and then utilize the cash and then go in for acquiring other companies. What does everyone think about this kind of a thing? Anybody can jump in, you know.
I guess it requires for you to have a vision. What are you going for, right? Without a vision, if you know, most searchers, you know, we're zero focused on just getting that, you know, first or second or a third, you know, deal. You might not have the luxury to have the vision, the experience, and the potential funding to think about, let me do a Lego piece combination here. You know, this business would fit really nice with these potential 3 others that I don't have yet right now. So the more concrete of an example you could give here, I guess the more we could learn. I mean, this is very interesting, but I'd love to hear more of a concrete, you know, historical example of when that.
I'll have to dig deep into it, and maybe next time we can come back to it. But
yeah, let me give you an example, and that's again a real-time example. Typical of very large companies. Fortunately, I had the chance to, you know, work in such companies, and it's so basically once we are doing these sort of holistic diagnostic of companies and or businesses, at that point in time, you find out, to Sandeep's point, for instance, focus is on revenue, not on margins, right? Or focus is on one KPI versus another. So, I mean, during that diagnostic, what happens is that we have to, you know, find out, fine, we've got 10 different KPIs. Which is the most relevant, or what are the most relevant 5 top KPIs that we should be focusing on? If we are focusing on wrong KPIs, which means we are achieving them just for the sake of our own, what you call, comfort, but actually it's not adding value. One example would be, and without naming the big giant, technology giant, the key, one of the key KPIs was a number of customers that were using a certain platform, right? That was the key KPI. So they were always measuring their success based on the number of users coming onto the platform and using the platform during a month or during a day, during a certain period of time. That was, and how much that was translating into your revenue and how much it was translating into your bottom line, that was sort of a tertiary KPI. Whereas in that particular case, the GMV, which is the gross market value or gross monetary value of a transaction that happens on platform, should have been the best KPI to look at for. Why? Because, for instance, say if it is a credit card platform where 20 million people are coming onto the platform and doing a transaction worth $1, whereas in comparison to another platform where only 10 million were coming onto the platform, on average, they were all doing $20 transactions. So which one is better? Not the latter. Why? Because there is more gross, monetary value, ultimately translating into higher revenues, ultimately translating into higher net profits. Whereas company one was considered to be bigger. Why? Because their platform access and footprint was higher than the latter one. So that is one. Again, how much it's like, the concept remains the same, and we translate the same example to even smaller businesses.
Yeah, I have another question, and I have another topic to raise here, is that when you look at a business, and for everyone to say, when we look at a distressed or tough business where we think we can turn it around, do you think a flattening sales where there is very less hope of improvement, or no, so no, I should not say that, whether it is a business which has margin compression or there's a cash being drained out because of the overheads, is that a okay business to take, or something which has very poor sale growth in the last few years? You know, it's an open topic. So whether we are hopeful of turning it around if we have a business which has a good potential of more sales, or something which has a margin compression going on in the last few years, or cash is going out a lot. Anybody can jump in. I have no answer to it, by the way. I'm just asking a question here. That's the easiest part, but I want everyone to throw their ideas into it, and then we form an opinion about it.
Sandeep, it's Austin here. I think like most things, it depends, I think, on the future operator. Myself, I'm not much of a sales guy. It's not my comfort zone. So for me, I'm more of an operator. And so I think for me, the business I'm currently evaluating has the margin crunch as well as declining sales, or forward-looking declining sales. So I think for me, I would focus on a place where where am I going to be able to influence most effectively? If the business is counting on, future sales and growth to get it out of distress or out of the kind of bad spot it's in, then that would not be good for me personally. But maybe you're a whiz-bang sales guy and less in the operations, and that might be great for you. Whereas something that's more margin crunch, that's needs someone to come in with a fine-tooth comb and find the efficiencies in the operations, might not be good for you, but that might be great for me. So I think it just kind of depends. But I think knowing yourself and what you're better at, and also kind of caveating, try not to have to accomplish all of it. You might not want to have to increase sales and operation efficiencies, and you might want to have to do all of it in your turnaround. But I think whatever you're better suited at might be a more appropriate fit for an acquisition.
Yeah, no, I agree with you. And even though I have a lot of sales background in the past, sales and technology and all that, I think personally, I think margin compression and margin and overhead management and reducing overheads and all that is more predictable outcome than the sales. And hoping, salespeople usually think, hey, I'm a salesperson. I can just go and maybe add a few lines and a few customers. I also think the same, I can do it. But after failing in a few startups, I have a humbling experience about sales and marketing. And it is the most tough thing. So I would say be cautious when you're doing it. And when you're looking at overhead and all that, that's easier in my opinion, and working on pricing is easier. And Vladimir, Nayab, Raul, anybody can jump in and tell Ryan to
I just want to say I appreciate your point of view, because as someone who does have an experience in sales, and I would be naturally leaning on that and having that maybe rosy, optimistic outlook, saying, I can just come in and increase sales. It's done. I know the process, GTM, whatever. It's not a big deal. But so it's nice to have a reminder that, yes, you're absolutely correct. It's not as predictable as software, companies out there that specialize in the specific software want you to think. It's not, type in a few things and, you get sales coming in, especially if you're coming into an industry that you're not necessarily you have background in. So appreciate you reminding that.
Awesome. Anybody else on this?
Sandeep, this is Ryan. It's really a matter of control, and you have a lot more control over your operations as discussed in sales. While there are tried and true methods like SEO to improve those, it feels a lot more speculative. So that's a really insightful observation. Thank you.
Yeah, awesome. And
there is no we can't have a sort of easy answer to that, or maybe a cookie cutter approach. We can't compare margin over sales or sales over margin, but we have to understand the concept behind what feeds the business and then go back from there. So what is feeding the business is actually the gross margin. Why? Because imagine you've got a business operation where you've got salaries, you've got rents, you've got other operations of say $10 million. That $10 million has to come from somewhere. Where is it coming from? It's actually coming from your business margin. And the higher the business margin, the easier it will be to fund these operations. If the margin is being wiped off, you will not be able to sustain your business operation. So which means the first and foremost important thing is to look at your margins. But where are these margins coming from? These margins can't be there unless and until you don't have good sales. And then comes the point of operational excellency, where you are controlling your cost or direct cost so that your margins could be improved or could be sustained, so that you can. So it's basically a circular answer, but it's actually cyclical, because unless and until you don't have margins, you can't sustain your business. Unless and until you don't have good sales, you can't have good margins.
Fantastic.
That's an important point. I mean, the whole thing is very holistic. It's when we come into when we analyze, we like to break things apart, but at the end of the day, it's very holistic. Follow-up question on this: when we're speaking about margins, rule of thumb, when you look at distressed businesses and you don't know much about it, you haven't dived into the documents and the statements yet, and you just have the margin, right? At what point do you want to look deeper, and at what point do you want to say this is not enough for me to work with? Is it a 10%, 15%, 20%? What is the number? Just curious. Does anyone have that a number to share?
I don't know whether that number is possible to be given by anyone on a particular product or a particular. It depends on the industry, the cycle, and the time of the market, and all that stuff, in my opinion. But but I want to also add another question, and I think Nayab, you can answer it because you have seen you have helped me review a lot of companies. Most of the companies, small businesses I look at, their gross margin is calculated wrong. And whenever I think a gross margin is right, and he always tells me, "Hey, why is this gross margin not including this labor or something like that?" Would you like to say something, Nayab, on that, and then and talk about what Vladimir said, if possible? In my opinion, if I tell you my opinion about what Vladimir said, I don't think it is possible for pinpointing that one particular percentage is good, but you jump in, and then anybody else can also chime in.
Yeah, I think Sandeep, the answer that you give, I'm just going to give the same answer, but in maybe a different way. But you've already nailed it. So basically, two things. What I've seen. Number one, I mean, margins depend upon industry we are operating in, and sometimes if you go even deeper within the same industry, you can have different margins because no two products are the same, no two businesses are the same. No two scenarios are the same. So for instance, if we go to FMCG business, the margins might be even 3 to 4%, sometimes even less. If you go to airline business, the margins could be even 1%, even sometimes less. If you go to services business, the margins could be even 60% or even more. So it all depends which type of industry you're looking at. So it's very difficult to sort of pick a certain number for a certain industry. So that's the first step. Secondly, I mean, while looking at such business, now, I mean, of course, I'm adding more complexity to your question, but I think the rule of thumb should be look at the margin and see how much that margin is covering your operating cost. If your margin is sufficient enough, or at least merely sufficient to cover your cost, which means it can be a good business because it's sustaining itself, it's keeping itself alive. So I think, that's the first rule of thumb I would always look at. And second to what Sandeep had been, alluding to, the examples that we were having, Sandeep, a lot of times people don't even do their accounting or their classification right. So they just keep pushing everything in their direct cost, whereas it is not. Sometimes they keep pushing, things onto they keep, paying for their, for instance, freight. And they put freight down there as administrative costs. Now, it could have been part of the cost of sales. So again, it all depends upon, how we are classifying. So we have to do a little bit of deep digging into how the financials have been constructed.
To add one thing more to what she said, and to answer Vladimir, I think benchmarking is also very important. And with the tools on SearchFunder like BVR and all that, I have not gone and looked at the gross margin, all that, but there are so many reports which can give us some idea about what kind of, or some, Google or ChatGPT can say, what kind of a margin at this kind of a company is good enough to just do a benchmarking into the costs as well as the profit margin and the gross margins. Benchmarking, in my opinion, is very important. But is there anything else we'd like to say anything here, or I have another one question, very important question. Okay. So another question I have is, suppose I think the most important thing before even you think of getting into a company which is kind of in a break even or in a is somehow bleeding is to have a ability to do your due diligence and read the financials and read not only the financials but also, like Victor said, understand the product and the capabilities of that product and the potential of that product, the business model of that business, and what their competitors are and what kind of models they have, what is the pricing, and what is there any improvement in pricing, how much is required to tens of other questions on that. So I would like everyone to maybe comment on this. Anybody? Should I volunteer somebody should talk about it, or is this a relevant topic, or otherwise we can move on to maybe what should we look at? One thing which we have not covered today is not only to look at the company and the valuation and all that and products and all that, but also to have a 30, 60, 90-day plan ready even before we actually go and acquire it. Because these kind of businesses can go south anytime, or maybe I should say much faster than anything else. So that plan is very important, and being a very strong leader in the initial stages, which show optimism to employees and everyone involved is very important here. Raul, you have an experience in this. What do you think?
Well, yes, we are in the middle of the target number one, full steam due diligence, and we are doing that 100-day plan at the same time. When we're starting the due diligence, we have different streams that we're following at the same time. I mean, these activities need to go parallel, and it really takes a lot of time. On our side, but also on the owner's side, on the seller's side. So it's very intense.
Yeah, just one example. Sandeep, allow me if you. Yeah. In fact, Sandeep and I, we were looking at a few businesses sometimes back, and to the point of due diligence and to the point of understanding the business. Like there was one business, we had 3 years financials, excellent results. But looking at those 3-year financials, the business, all those results pertain to post-COVID events, right? So which means the business, did very well because of the situation in COVID. And if you start looking backwards, the business was not doing as well. So there was one big black swan event which happened, pushed the business forward. The business did very well. 3 years, the revenues just like skyrocketed, profitability was high. The person, thought of, hey, this is the right time to sell the business off. Now, looking at those 3 years, if somebody wouldn't have, thought a little bit deeper, we could have even bought it, right? Because the business was doing very well. But if you just like in the hindsight, see, what made the business do so well during these 3 years, and what's going to happen in future? So ultimately, we found out the business would be declining over a period of time. So, this is one example where we should not just look at myopically on one element, but we should be more holistic in our approach while doing a due diligence.
I think yeah.
Sorry. The tool we're using as a baseline is business model canvas and SWOT analysis. So we can have the glasses or look at the history of the company through these glasses and identify those points of black swans that happen and all that, and then try to predict what needs to happen to escalate the business a little bit more. That's our baseline.
Okay, so I want to share 2 things here, and then we will wrap up. And that will be can happen in any other scenario also, any other business which is a profitable business also. But in a case where we are thinking of acquiring somewhat distressed business, this becomes a critical factor. Why? Because profitability or profit, if any, is at the rock bottom. It's razor thin profits, and we are working on it. Now, one example which I will give you, there's a guy who I was following, and I'm still following that person in at a business. He has given me 3 years of financials. I look at the financials; they give a different story, and then he gives me stories after in my meeting and in emails, and saying, last year was bumper year, 2022, and he said he moved 125,000 or 200,000 worth of sales to this year quarter and jumped it over from last year to this year. I said, okay. Then the next, we couldn't find any. When we found in 2023, we delayed the conversations, and in 6 months we realized the person is now not making enough in 2023. And I said, if you are in loss, if I bring that last year? He said, no, that was different and all that. So that discussion went away. Then another communication which has unsettled me in this kind of a business scenario is, and it's a way of that person. I think Nayab said he must have seen some money in his bank and took 150K out and he says, I have taken this much loan from the business and that is my profit. I don't see 150 either in balance sheet or in the P&L or any other place. And Nayab has looked at it and figured out, either he's lying or it is not there at all. So that's the kind of nature of the businesses in the 1 million to 2 million kind of up to businesses we come across all the time. So we have to be very, very careful, I think, especially if we are going into a distressed business scenarios. But anything else, and we can close down this. And if you all feel this is good conversation, we can keep meeting maybe twice a month or something, and you can come in and we can keep going deeper and deeper and help each other out on answering these questions, specifically on these kind of topics. Okay,
from my part, Victor speaking here. So thank you very much for putting that together. Quite some inspiring thoughts on that. Just two things that I really take from today is one thing where I really think there's an opportunity is just in that type that there's like a demand supply thing where you really have few people looking for these kind of businesses, but on the other hand, there's a high supply on distressed businesses where you really can check this out. But on the other hand, I think what I learned also is that you have to be much more careful actually in the search, and that maybe is also the problematic part, as it's not so quite good covered in literature and experience within the search fund. So but thank you very much, and I would be very happy to follow up on these discussions.
Okay, awesome. And I'm not saying, and we're not saying it is easy, we're not saying it is, but we're saying it is possible. And we may be, like you said, Victor, there may be hundreds of opportunities, and some of them we are ignoring because of our focus to get good, robust cash flowing businesses. And I have been doing the same, by the way. So I am I'm opening myself up to new thoughts. That's my take. Thank you very much. Anything else, Vladimir? You wanted to speak something, or you were just...
Yeah, just wanted to say thank you for putting this together. I'm curious to learn more. Thank you for even thinking about this, because before that, it seems like you're a bit afraid to go in and scratch the surface because you feel like those kind of businesses, you might not know what to even do. But with, discussions from you and Nayab was very helpful to just give, your perspective of what to look for. So in the future, maybe if we can put together some sort of a checklist, that maybe can help us to look for a few things. You maybe picked up on the theme here. For me, I'm looking for some rules of thumb where to say to disqualify businesses quicker rather than go ahead and spend a long amount of time doing a full due diligence just to realize that this is not a good fit. So if we can simplify the process to get, 80-20 rule done here, that would be hugely helpful to myself and probably others as well. But thank you.
Thank you very much. And I thank you for the idea. I will work on it, and maybe next time we can discuss out of other things, that checklist also. Thank you very much.